Revocation or termination of S Corp status. So once elected and approved to become an S Corp, how is that status revoked or terminated? Well, the S Corporation status can be revoked or terminated for federal income tax purposes in certain situations. Now, you can obviously say, hey, I don't want to be an S Corp anymore, or the status can be taken away from you because of, as we see, a couple situations here. These situations can include voluntary revocation, involuntary termination due to failing to meet eligibility requirements, or exceeding the passive income threshold. We'll talk about that as well. Here are some scenarios that could lead to the revocation or termination of an S Corp's status. First, voluntary revocation. Shareholders holding more than 50% of the outstanding shares of the corporation may choose to revoke the status by filing a statement with the IRS. Why would you do that? Well, maybe you want to, you're getting bigger and bigger and you want to make that S Corp into a C Corp so you can list it on the stock exchange. That would be a great reason to do so. The statement must include information about the corporation, the number of shares held, and the effective date of the revocation. Ineligible shareholders. Now, as we kind of talked about before, if an S Corporation has an ineligible shareholder, such as a non-resident alien partnership, C Corporation, or an ineligible trust, its S Corporation status can be terminated. And then exceeding the maximum number of shareholders, if we have more than 100 shareholders, that would give us the boot out of there. Obviously, don't lie to the IRS and say you only have 100 when you have 101. That will not end well for you. Got a few others here, and really just a lot of breaching these eligibility requirements initially. We'll talk about that excess passive income as well. Issuing a second class of stock. We're only allowed one class of stock, so if we issue a second class of stock with differing economic rights, such as differences in dividend or liquidation rights, it's going to lose its S Corporation status. Violation of the domestic corporation requirement. If you cease to be a domestic corporation and you are now a foreign corporation, that is not good either. Disqualified corporations. If an S Corporation becomes a financial institution, again, this is kind of the least important of the batch, but it's still there. It's kind of what we saw before as well. And then excess passive income. This is a rule that exists to kind of prevent a corporation from electing to become an S Corp. So it's kind of a shell company and exists to just get income to the shareholders with as little tax as possible. So if an S Corporation has accumulated earnings and profits, which is a carryover from when it was a C Corporation or acquired from another corporation, and has gross passive income, such as interest, dividends, rents, royalties, exceeding 25% of its gross receipts for 3 consecutive years, your status will be terminated. The goal here is that the IRS wants this corporation, this S Corporation, to be in active business, such as a bakery, such as, let's say, a transportation company, something that's actually conducting active business as compared to just raking in that passive income, such as interest, dividends, rents, and royalties, so that it can pass those through to shareholders with little tax. Now, if an S Corporation loses its status due to involuntary termination, it generally cannot re-elect S Corporation status for 5 years following the termination, unless the IRS grants a waiver based on reasonable cause for the disqualification. In order to avoid losing the S Corporation status, it's going to be crucial for the corporation to continually monitor its eligibility requirements and take corrective actions when necessary. We've got more wonderful examples here. I know you love examples. I love examples. Great way to use our rules that we've been seeing in practice. Now, let's say that XYZ Corporation is an S Corporation. They've got 3 shareholders, John, Jane, and Mark. They each own 33% of the company. In the middle of the tax year, the company fails to meet the S Corp requirements due to unintentional errors in maintaining the S Corp status. The shareholders with more than 50% ownership, John and Jane, decide to voluntarily terminate the S Corp status. Additionally, more than 25% of the company's income was passive for the last 3 consecutive years, which only matters if the company was previously a C Corporation. Again, that rule exists to allow the IRS to control these entities so that you can't make a lot of money as a C Corp, convert it to an S Corp, and then cash out with only single taxation. C Corporations have that double taxation. We'll talk a lot about if it was previously a C Corp. Now, are you not previously a C Corp? Because you may be asking, hey, Nick, didn't you say you have to file to become a C Corp and then elect to become an S Corp? Well, what happens there is you're not considered a C Corp if A, you elected on the day that you filed to become a C Corp, or if you just didn't have any activity, right? And if, let's say, now generally on the exam you're going to see, it's that the first example. You're not considered previously a C Corporation if you file to become a C Corp and elect S Corp status that same day. But also, let's say theoretically, they didn't have any business for 6 months and then they started ramping up business. But before they did that, they filed to become an S Corp. That is the difference. The concern is that you have C Corporation activity and you become an S Corp to quote unquote avoid the double taxation that comes with being a C Corp. So again, that's why we're dealing with that rule. Memorize that rule, 25% passive income, last 3 consecutive years. So termination due to a failure to meet S Corp requirements. Since XYZ Corporation fails to meet the S Corp requirements, the company's status as an S Corporation is terminated. This means that the company will be treated as a C Corporation for tax purposes going forward. Voluntary termination by shareholders. We're kind of going through all the ways it can be terminated. Since John and Jane own more than 50% of the company, they can also voluntarily terminate the S Corporation status. This means that the company will also be treated as a C Corp going forward. Now, all of these 3 things happen in this example. In reality, it would be for one of these official reasons. It wouldn't be all 3 reasons, just kind of demonstrating 3 different ways that it can be eliminated here, and we'll keep moving forward with others as well. More than 25% of income is passive for the last 3 consecutive years. Now, assuming that XYZ Corporation was previously a C Corporation, the fact that 25% of the company's income was passive for the last 3 consecutive years means that the company can no longer qualify for S Corp status. Again, just remember what types of entities these are meant for. Smaller businesses that are actively conducting business, maybe a small real estate company, something like that. Termination midway through the year. Well, since the termination in this example did occur in the middle of the tax year, the company's income and expenses will be allocated based on the number of days that the company had S Corp status and the number of days that the company had a C Corp status. Let's say that the company had S Corp status for the first 6 months of the year, and then let's say there was a date, let's say July 1st. The C Corporation status began on July 1st. For the last 6 months of the year, that's how it's going to be taxed. Now we're going to close the books when the S Corp terminates. When the S Corp status is terminated, the company must close its books as if it were the end of the tax year. Any income or expenses earned or incurred after the termination date will be treated as income or expenses of the C Corporation going forward. Now, in summary here, the termination of an S Corp can occur due to failure to meet the S Corporation requirements, voluntary termination by shareholders, or the company's income becoming more than 25% passive for the last 3 consecutive years. And then we also saw how the allocation of income and expenses is based on the number of days that the company had S Corp status and C Corp status during the tax year. Lots of great run-throughs and examples of how this all works. Just using examples, gonna burn it into your mind. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.